Employees of the CFPB will have a lot of time in their hands. Perhaps that's the opportunity to brush up on their solitaire skills. But on a serious note, Scott Bessent, confirmed as Treasury Secretary late in January, was named the acting director of the CFPB just last week. Now, Bessent replaces longtime director Rohit Chopra, who was fired on February 1st. NPR reports that in an internal email shared with NPR, staff members were instructed to immediately cease much of the Bureau's work, including issuing or approving proposed or final rules or guidance, and suspending the effective dates of all final rules that have been issued but have not yet become effective. Staff members were also instructed not to commence or settle enforcement actions, nor to issue any public communications of any type, including research papers. The directive was made in order to promote consistency with the goals of the administration, said the email. I look forward to working with the CFPB to advance President Trump's agenda and to lower costs for the American people and accelerate economic growth, said Bessent in a statement. The CFPB holds the authority to create and enforce rules regarding consumer financial products. That includes mortgages and credit cards. And although Democrats in large part created the agency to protect consumers from abusive financial practices, the Bureau has continued to be viewed by Republicans as an unchecked, unconstitutional power, since much of its funding, all of it in fact, comes directly from the Federal Reserve and not through the congressional appropriations process. While the CFPB regulates nearly every facet of consumer finance, the question is, how will these developments impact mortgage lending? In the short term, not much. Lenders are likely to continue to operate under the existing regulatory framework established by the Bureau, and no substantial changes to consumer mortgage disclosures are likely. The Bureau has successfully curtailed many predatory lending practices over the years. However, the agency has faced criticism and several attempts to dissolve the Bureau since its inception in 2008. Senator Ted Cruz summarized the Republicans' view of the agency, saying, "The CFPB is an unelected, unaccountable bureaucratic agency that has imposed burdensome and harmful regulations on American businesses, banks, and credit unions." Housing Wire reports that Francis X. Riley, a partner at Saul Ewing LLP, who specializes in RESPA law, says that he does not believe that this pause will have much of an impact, which is interesting, saying that court rules and scheduling orders affecting CFPB enforcement actions are not frozen, and therefore the litigation will proceed as required by those rules or specific scheduling orders, said Riley in an email. He also noted that the Trump administration, despite their outward disdain for the CFPB, cannot dissolve the Bureau. An act of Congress would be needed to vacate the Consumer Financial Protection Bureau under the Dodd-Frank Act, and that's something that few in the enforcement space expect to happen. But this does not mean that the Trump administration cannot seek to weaken the CFPB, to the point of irrelevancy. In the meantime, mortgage lending will continue to operate under current regulations, albeit without the introduction of new rules. If you've ever carried significant credit card debt, then you know what a financial and emotional drain those seemingly harmless little pieces of plastic can be. Coupled with auto loans, medical bills, and student loans, the debt burden of Americans in retirement today is threatening their financial security. Now imagine that you're the one living on a fixed income. Unfortunately, a recent LendingTree analysis reveals that 97% of Americans aged 66 to 71 still carry non-mortgage debt. And it shows that retirement age adults across the 50 largest metros have a median non-mortgage debt balance of over $11,000, of which approximately 1/3 is for auto loans and another third is for credit card balances. Only 15% still have active student loans. LendingTree chief credit analyst Matt Schultz admits that he's not surprised that debt totals are so high among retirement-aged Americans. The combination of a fixed income, stubborn inflation, rising auto prices, and sky-high interest rates on both cars and credit cards has created this perfect storm that has left many, many Americans wrestling with debt. LendingTree has 3 recommendations for retirees in this situation. The first is to pay attention to interest rates. Those carrying significant credit card debt may qualify for a zero-balance transfer card or seek a debt consolidation. The second option is to decide what's important. Do you really need that new vehicle? How many cable subscriptions are necessary? Should you get a part-time job? The third recommendation is to ask for help when it's needed. Lenders are often willing to work with people going through a short-term financial rough patch or whose financial circumstances have changed. Talking to a nonprofit credit counselor can be an excellent choice, too. Like most financial publications, LendingTree ignores the potential solution that may be right over the heads of older Americans who now find themselves burdened with debt payments: a reverse mortgage. A reverse mortgage could help to consolidate those existing non-mortgage debts and, of course, eliminate the required payment on the mortgage, which would be a boon for a retiree's monthly cash flow. And a word to reverse mortgage professionals: be mindful of financial fact-finding, because it reveals a homeowner's sources of income, current monthly debt obligations, and other assets that may be used to see if a reverse mortgage could provide needed relief. Not knowing this, you don't know where or if a reverse mortgage may be a suitable solution. A recent CBS News column notes 3 reasons why Americans may want to tap into their home equity, even if their home has been paid in full, saying making your final mortgage loan payment is a critical financial milestone, and one that's often painstakingly accomplished after diligently making mortgage payments for decades. So it may not seem valuable, at least on the surface, to subsequently borrow from your accumulated home equity, particularly now that interest rates are elevated. But today's unique economy, they say, has made the benefits of home equity borrowing clearer. When using a home equity loan or home equity line of credit, or HELOC, owners can easily tap into their home's worth and use it for many expenses, large or small. But is it worth borrowing home equity from a paid-off home? In some circumstances, especially now at the beginning of 2025, it actually may be. One reason is to finance home projects, saying one of the smartest ways to use home equity is to finance major home repairs and renovations. And if used for IRS-eligible projects, the interest paid on a home equity loan or HELOC can be deducted from your taxes for the year in which the funds were used. They say that's a major advantage over other borrowing products that simply do not have that deduction, and it makes concerns over interest rates a little less significant if you know you can deduct the interest paid on your next year's tax return. But I have to note, what they're overlooking is that unless your itemized tax deductions exceed your standard deduction as a single individual or married couple, then that may not even be applicable. So they should have included that. CBS News adds that it's important to determine which projects can qualify for a home equity tax deduction and which ones won't before applying for the funds. The second reason to use your home equity is to pay down high interest rate debt. Today, the average credit card interest rate is approaching 23%, and CBS notes that the average home equity loan is just barely over 8%, which makes it almost 3 times less expensive. So they add, if you're saddled with a significant amount of credit card debt today, and the average American now owes about $8,000 in credit cards, it makes sense to pay it down with a low rate option like a home equity loan or HELOC. Now that, of course, they don't want to default on the HELOC because they could lose their home, unlike a credit card. And the third reason CBS gives for using your home equity is to pay for major expenses, saying that credit cards aren't the only borrowing products with double-digit interest rates today. If one looks at a personal loan, for example, the median interest rate is just under 13%. And since most personal loans are at a fixed rate, that means the borrower is going to get stuck paying a potentially higher rate if inflation does drop or cools in the future, at which point you would want to refinance. Now, it really doesn't make sense then to go the route of a personal loan when you can pay for the major expenses in a cheaper way via your home equity. CBS concludes saying, so if your alternatives are costly, consider a home equity loan, a home equity line of credit, or even, yes, they mention it, a reverse mortgage if you're over the age of 62.